Want to kind of talk about scenarios. I shared an earlier video today where we were going over so many different scenarios, and I can't even begin to tell you the number of different scenarios that we've run into, this month. And I wanted to highlight kind of the top 5 scenarios that we had that truly shows the amount of different things that us mortgage professionals endure on a day-to-day basis, right? The first one was the one that I shared from the closing that was supposed to happen on Monday. Kind of sucks, it is what it is, but it was a VA loan. The buyer was purchasing his second property utilizing a VA loan, and it's a little bit of a difficult file in the military. That always kind of plays a little bit of curveball. He was simultaneously also a police officer. But we actually ended up running into a scenario where we were clear to close. And then literally on the final day of closing, we had a hurdle where the place actually was flooded, which kind of sucks, right? And I was completely shocked. Go figure, obviously the seller simultaneously didn't know, but we actually ended up canceling the transaction. Really sucks. I mean, we were closed, clear to close. Docs were funded. We were supposed to close in the next literally 15 minutes. And I get a call from the client and he was irate, right? Not too happy. But at the end of the day, now we're back on the prowl. We're checking out a few homes out there and we're taking it from there. Now, another scenario that I wanted to kind of touch base on was also another VA buyer. He was actually looking specifically in New Jersey. He was moving from Colorado to New Jersey. And the original loan that he had was a VA loan as well. He was now going to take that VA loan and have it assumed by somebody else. Colorado happened to be very, very close to the base. There was a lot of different military applicants and people that were interested in his home. So they assumed his mortgage. How does assumption of mortgages work? Let's say, for example, you're looking at a $400,000 home. And let's say that the mortgage for the current seller is, say, $300,000. You have the ability to assume the $300,000 mortgage, right, that the seller currently has, but you would have to cover that $100,000 difference essentially in equity or the sale price of what the client or seller essentially has. So in this particular case, it ended up working out. Many times it's really tough because we all know home values have continued to appreciate. We're consistently seeing that. It's going to get even crazier in the next 3 to 6 months. So we want to kind of keep that in mind simultaneously when we are educating our clients about those options, right? The other thing that we also went to a different client, we had a scenario where a consumer was in the process of looking to refinance their home. The home was actually still currently listed for sale, which is a big no-no. They were trying to do essentially a refinance from an LLC to an FHA loan, which you're allowed to do. The person took out a fix and flip. Couldn't necessarily go FHA, obviously. Couldn't go 203K because it was extensive repairs that were needed, structural simultaneously as well. But what we ended up doing was we removed the house off the market because he was going to potentially sell it on the market, added the client's name to the title and deed, which now prompted the eligibility for the consumer to be able to co-sign, to be able to refinance, right? Another different scenario that we ran into with a different client, there's no shortage of scenarios, guys. There's so much stuff that's out there. We are not the cookie cutter type of lender. Do we do those? Yeah. Most of us have seen some of our past reviews. We've closed our deals in 3 days, 5 days, 7 days consistently. If you don't believe us, check out our reviews. They're black and white that highlight the same. We know what to look for. I shared earlier a client that we had lender on Friday could not issue an approval. Actually, couldn't even be found, right? We took the file over. File was simultaneously submitted to the underwriter on Monday, approved on Tuesday, and guess what? We ordered the appraisal on Wednesday. Appraiser went to the property Thursday, appraised the property, and we already got the appraisal report back at 100% of the purchase price as is. So again, the opportunities of being able to be well-versed, well-educated, and have the various different tools and expectations available in front of you is just so important if you're trying to be successful in this business, okay? Whether you're a referral partner, another mortgage professional who's just not getting that necessary support, you want to be able to align yourself as it gets busy next year, right? If your interest rates are super, super high and you're working under a branch where it's just too high, you're never going to win. I don't care what so many different options that you have in front of you. If you're a real estate professional simultaneously who's working under the cloud brokerage model, but you need that true real mentorship, maybe the cloud model is not good for you, and vice versa. Some people who are a little bit back with the stick with the brick and mortars, your Weikerts, your Kellers, your Remax, and all those. I have some of them who may necessarily belong better to that cloud-based model or vice versa. So many different strategic avenues that we want to make sure that us as mortgage professionals have the opportunity to provide those values to our referral partners to truly set the proper expectations in terms of what you're able to qualify for, what you're able to most importantly afford for our clients, and then have a plethora of other opportunities, such as we now do HELOCs for primary homes and investment. We also simultaneously have DSCR, bank statement loans, and a lot of different variables. Now we're talking about bank statement loans. Ran into a good colleague of ours with one of our referral partners buying a new construction home out in Robbinsville. Beautiful, beautiful home. I mean, it is a new construction. One of the things that the listing agent and the seller were a little adamant on was the house is listed for 1.6. They did not want us to go in without waiving the appraisal. So essentially they wanted us to waive the appraisal. Now, new constructions obviously get a little tricky, and it is in an area where it's predominantly not as many comps, not as many comparables that we could really relate to when it comes to new constructions in that area. So what did we do? We got the file. I believe it was Monday. The offer was accepted. We ordered the appraisal before we got out of attorney review because that was what we agreed on. Ordered the appraisal. Appraiser went there 2 days later. We got the appraisal report, and it satisfied 100% of the purchase price. So we were able to successfully qualify. Now, while we were diving in heavily and all this happening behind the scenes, we were looking at a lot of the different client options available in front of them, right? And there's so many different scenarios, and the importance of working with the right professional. Whether you go the standard conventional route or you go with a bank statement loan or you go with an ABC loan, we have no financial incentive, okay? The SAFE Act mandatory requires all mortgage loan originators to be compensated the exact same way. And you cannot be compensated if you do more. You cannot be compensated if you push one loan program over another. It's against the law. The SAFE Act in 2008 completely negated that. So we want to make sure that when we're talking to our consumers, it comes from a true advisory position, right? We're going to go over all the various different topics and aspects. And remember, we talk about the 4 C's. When we qualify a consumer, we look at the client's credit score. We look at the client's capacity to repay the loan. We take a look at the client's collateral and essentially what they're looking to buy. And then we take a look at their capital and make sure they have access to the necessary funds needed to close. That is exactly what we did with every single scenario I went over with you guys. From that VA buyer whose house got flooded, from the consumer who simultaneously couldn't necessarily qualify. So we had to kind of do the pivot in terms of waiting to sell their house in Colorado in order to move to New Jersey. Just like that scenario I told you guys with that client who needed to refinance and get the home into their individual names or get it off the market. We're going to have to constantly pivot, and heading into 2024, the importance of us making sure that we're constantly pivoting along the way is going to be the determining factors for those of us who are going to remain successful in this business and those of us who are simultaneously just going to be dragging their feet or exiting the business. I'm going to keep doing these consistently, these impromptu scenarios, jumping on, really sharing with you guys some of the things that we have going on behind the scenes. Any questions that you guys have, as always, visit our website, gotmortgages.com, and I look forward to helping you guys. Have a blessed holiday, guys, and I'll see you guys soon.